The mission of the Australian Energy Regulator is to work for Australia's future productivity and living standards by contributing to a decarbonising, affordable, reliable energy system for all consumers. The regulator proposes a rate of return increase from 5.78 to 6.86%, which gives an 18.68% increase in capital return, which translates to at least a 10% increase in user charges. This is not affordable for many people, and it is certainly not in the interests of consumers. So what's the reason for the regulator's increase? We're told that the increase is to attract institutional investors, particularly overseas investors. There is another way to get capital, and that is to attract consumer investment. Investing in regulated businesses gives investors a fixed return on the regulated asset base. Normally, the amount of money invested plus any additional funds invested from any source. It is an excellent investment and is attractive to any Australian electricity consumer. However, Australians cannot invest in regulated electricity industries as they are reserved for existing investors in the form of equity or loans. Consumers simply cannot invest. It's pretty hard even for Australian institutional investors to get any investments in regulated investments, as most of them seem to have gone to private equity. So consumer capital is an alternative to equity and loans. And we suggest that consumer capital or prepayments for electricity treated like an annuity is a way for consumers to invest. The form of the annuity is in the rate of cheaper electricity. So a consumer purchases, say, 10 years of electricity but receives 20 years of electricity. Pays for 10 years of electricity and receives 20 years of electricity. If the consumer cannot use the electricity, they can sell their prepayment at the lower price to another consumer. Not at the lower price, at the total price to another consumer or the business. When consumer capital is used, the value of the prepayment is released, and the original capital still resides with the business. However, the capital has been paid for by consumers, but which one? Rather than determining which consumer gets the capital, we can let it go in proportion to the amount of money a consumer pays. The payment goes to the business to be reinvested to continue to pay the annuity. So what happens is that the capital is paid for, but it still exists, and the new capital that has been paid for goes to the original investor, and the old capital goes to the consumer. We propose that the regulator require regulated industries to offer all new capital first to consumer capital, and that the consumer capital be a 10% annuity for 20 years, or in loan sort of terms, it's equivalent to about a 5% return over 20 years. This will attract Australian consumers who we believe will swamp regulated business with offers. It is suggested that they should go first to the lowest wealth consumers. In other words, what we want to do is to bring some competition into the capital market. And let's see whether we need the international investors. Well, how to start? This is a pretty radical proposal, and it's not something that you can just do. You have to try it out first. And we suggest that we try it out first with community batteries and perhaps other storages. The benefits of all this is that all consumers and investors benefit. Everyone who buys electricity will get some capital. Everyone who buys electricity will get some capital. Importantly, it entitles consumers to a voice in the governance. What it means is that consumers now have a genuine way of being able to ensure that their interests are met because they will be on the boards of these different organisations. And finally, it results in a lower cost of storage. It makes batteries viable. The outcomes are, in short, that consumer capital is economically viable at $800 per kilowatt hour. $800 per kilowatt hour is achievable today, and probably a little bit less in bulk, whereas company finance batteries will require subsidies from the government in order to become economically viable. Well, how can this be true? These are the same batteries, the same cost, and all we've done is just change the form of capital. Well, it turns out that prepayments are a more efficient form of capital. And what that means is that you get more investment at a lower cost for the same amount of capital. There's actually no cost to transfer capital when we transfer capital as part of a payment. That means that there's no interest or capital gains. There's no cost of any capital markets. We don't need any capital markets if we transfer money with transfer capital with payments. And the most interesting one that I find is that capital moves at least twice the rate as it does today. Capital nowadays does sit in overpriced assets all over the place. And the electricity, if we look at the latest sales of the ones that have moved from the stock market to private equity, they are very, very highly priced. And what that means is that those people have to get their money back. That means that that capital is, those assets are actually overpriced. So what we want to do is to regulate community batteries to use consumer capital at a 5% rate of return. And let's try it out and see how we go. More information, Kevin Cox, kevin@wlpc.com.au. Thank you.